Joining me now is Chris Weston, the head of research at Pepperstone. Chris, good morning to you. Let's go to your motherland, or which I assume is your motherland, but over to the UK. How have the markets responded following the election win of Boris Johnson?
Well, we saw, I think, all the gains came through when the exit polls came out last week, and we saw 368 seats being elected, and the cable or sterling against the US dollar pushed up above 135. But all that move's really been given back, and actually, what's quite interesting is that last night, we actually saw the pound against the US dollar actually fall below that level, and actually is trading at a lower level than before the election. And I think the interesting thing here now is that as we have such a sizable majority for Boris Johnson's government, we should see fairly safe passage for his previous election manifesto, which of course is trying to pass the Brexit bill. So that should go through the House of Commons fairly easy. But what everyone's really concerned about is the fact that part of the bill, or one of the legislative pieces part of that bill, is that when we go through to the next stage, which is the transition period, where they'll dictate the future relationship, talking about tariffs for different industries and those factors, is that has a deadline of end of 2020 because it is such a complicated beast. Most people believe that we're going to need to see that extended by 2 years, potentially even more. And Boris Johnson is putting legislation to say that we're not going to be able to extend that deadline. So it does put the hard deal back on the table. Basically, anyone who thought that Brexit was going to be smooth sailing, now we've got this deal in place, is sadly forgotten. And Boris Johnson is clearly using this hard Brexit as another negotiating tactic again.
I'm just looking at this now, Chris. So £1 equals 1.92 Australian dollars at the moment. Where do you see that going in the next few months once Brexit is finally realised?
Yeah, I think had you said to me yesterday, before we saw this talk that Brexit bill is going to be pushed through and they're not going to be able to extend the transition period, I'd say that there's a pretty good chance that we're going to see sterling against the Australian dollar moving sharply higher or continuing to move higher. There's a lot of attractions about the pound at the moment, and if we go into the February 4th meeting, it does look like the RBA are probably going to cut rates again, and that's not fully priced, only about 55% priced in. So I would make that argument. Now we've got this uncertainty, you're not so sure, but I do like the pound higher against the Australian dollar over a longer period.
Okay, the Australian dollar, a bit of a weakness overnight. What's that about?
Well, I think the sort of the chance of European traders and US traders getting a chance to react to those minutes. We've been hearing about this gentle turning point, the Reserve Bank feeling quite good about the Australian economy, and obviously the external factors such as US-China trade have showing convergence. We're obviously talking about reductions in tariffs, even though there's still a large amount being tariffed or being taxed. But I think that the minutes have opened the door now. They've said that there's more stimulus to come if needed. They've said they'll look at the economy and make an assessment early parts of 2020. And, if we get a jobs number tomorrow, which is, somewhere close to zero, and we get the unemployment rate pushing a little bit higher, obviously that's hypothetical, but if we do, the market will ramp up its expectations of a February 4th rate cut from around 55% at the moment to around 70%. It will become a market consensus. So I think this jobs number this week could be really important. But I think the weakness we've seen overnight has been a reflection that European and US traders have reacted to that fairly dovish set of minutes.
Well, what are the factors that you will be looking at, Chris, leading up to that the next RBA meeting on the 4th of February?
Well, I mentioned there the unemployment numbers. I think that's absolutely key. They've made it pretty clear about the labour market being of utmost importance to them. So tomorrow, as I say, we get this jobs number. The market's looking for 15,000 jobs. They're looking for the unemployment rate to stay as it is. But then we go through the end of the year. There's not a huge amount necessarily to inspire. Early January, we've got the November retail sales number. 23rd of January, we've got the next employment number. And again, if that's depending on the outcome of that, will determine whether we get the nail in the coffin. But yeah, I think what's interesting there, if you go to the government's recent MYEFO, you've basically got a situation where the government said, we're just concerned about the surplus. If there's going to be any stimulus, it's going to come from you guys, the RBA. Don't expect us to help you out on the fiscal side, and it's really the RBA who are going to have to do the heavy lifting. So I think the market has made up its mind now that if we're going to get future stimulus, which I guess given the recent savings rate that we've been seeing, people are saving, they're drawing down, they're spending, they're paying back debt. People don't want to spend. If stimulus is coming, it's going to have to continue coming from the Reserve Bank. And I think what's interesting as well is if you go into yesterday's set of minutes, is the Reserve Bank are quite confident in the transmission mechanism by which cutting interest rates is feeding into the real economy, given what banks are passing on. So I think that they actually believe what they're doing is having a positive effect.
OK, Chris Weston, Head of Research at Pepperstone. Appreciate your time, Chris. Thank you for joining us.